Hey everybody, Marty Mazur. Good afternoon, June 9th, 2016. This will be your last video for this week. You're looking at the one-year daily chart. Today, the market actually was down noticeably at one point during the day. In fact, it started off down and looked like it was shaping up to be a pretty negative day. But by the end of the day, we were down just 3 points, 3.6 on the S&P 500, about 19 on the Dow. NASDAQ actually had a pretty decent down day, if you will, but overall, amazing resilience. I have to confess, I'm surprised at how well this market is holding up. You see, we have been trading right within this upward sloping wedge pattern, as technicians would call it. And here's today. You can see the left little notch is where we opened, the right notch is where we closed, and although it doesn't look like any change, there was just a little change there. And we continue now to press up against this trend line that was established with two prior peaks back here, and then right here is your all-time high. So we are just right there within a stone's throw. My constant complaint of late has been lack of volume, and you can see as we've continued to mount higher, volume has continued to go lower. Volume is the number of shares trading hands. Typically, in a good rally, a good sustainable rally, you want to see more volume. Could get some good news tomorrow. You could see a lot of money come screaming in off the sidelines, and then suddenly I'd be talking optimistically as it relates at least to volume. As I've shared with you of late, other technical indicators are improving, and so we'll see. We can talk about the Great Britain referendum in 2 weeks from today, and the fact that it does not seem to be all, well, let me take that back. The VIX, of all the volatility index, actually had a pretty good day today, so it did rise. I was complaining yesterday about how cheap it was, and not necessarily complaining, I should say, observing how cheap it is when we have what could potentially be a very volatility-inducing event within 2 weeks from now. I think that the market or our traders, short-term traders, I think are feeling sanguine, largely due to the fact that the Fed is not going to raise interest rates this month, and this overwhelming belief among professionals that the Great Britain referendum is going to result in the folks voting to remain in the European Union, despite what the polls say, but certainly consistent with what odds makers are showing. That would be my base case as well. So maybe the market's right, maybe it shouldn't get all upset. If we get through June 23rd and then we don't, and as I expect, Great Britain remains in the European Union, it'll be interesting to see. If the market stays very calm up to then, you might see somewhat of a sell-off after that, because that good news is then going to be over. And that good news would then provide one less concern for the Fed, and then we'd be talking about a July rate hike. So a lot of economic data between now and then and so on. But I want to offer up, there are several potential explanations as to why the market is doing so well against what look like and feel like some pretty decent headwinds, and against valuations that look kind of rich. I've talked to you in the past about breadth, or at least I've made mention of it. I want to illustrate just three things for you here very quickly, and then I'll close. The chart that you're now looking at, the green line is the S&P 500 cap-weighted index, and that's the one we're all familiar with. The white line, the shaded area, is the S&P 500 equal weight index, and many of you may not have heard of that. But the way a cap-weighted index works is that the stocks that have a greater market capitalization, Apple, for example, being a monster company, when Apple moves versus, let's say, when some smaller company, Johnson Controls, or some smaller company moves, Apple is going to have a much greater influence on the movement of that green line than the smaller company is if they both move, say, 2% or 5% or what have you. In the equal weighted index, Apple is just one stock amid all the others, and if Apple goes up 2% and another one goes up 2%, they are going to have exactly the same influence on the index. So this is a legitimate breadth reading. Now, what I mean by breadth is, as you might suspect, it's really to what degree are all boats rising or falling with the tide. meaning when the market or when the green line does really well against a not doing so well white line here. So when the cap weighted index is really screaming, but the equal weighted index isn't, what that suggests is that the market is being bolstered or pushed higher on a limited number, probably big high cap names, and the rest of the market is just kind of floundering. Good looking rallies that are sustainable tend to be accompanied by very good breadth. So what you're looking at right there is the breadth chart using these two indexes for the year 2015, which was dubbed by the Wall Street Journal as being one of the toughest years in history to make money in the market. Now, I want to show you what that same relationship looks like in 2016. So when I've been saying that breadth is improving, this is one of the indicators that suggests it has. So this recent up move that we've seen in the market, all the way back to pretty much when it bottomed in February, has been a better looking rally. It's been more companies have participated to the upside. It hasn't been nearly as dominated by a few big names. So that's important and that's encouraging in terms of the sustainability of the current rally. And then the other one I wanted to show you, the other measure of breadth, is the advanced decline line. So at the end of the day, and this is the S&P 500 we're looking at, you're going to have companies that go up and companies that go down. Today was a slight down day, and I think it was something like 290 stocks actually declined, but 210 actually advanced. And again, when you have a situation with a cap-weighted index, like you do the S&P, and that's the yellow line in front of you, you could actually have a day where you have more decliners than advancers. But if those advancers are monster names like an Apple, the index could actually go up. But it really doesn't say something good about the market if other companies and other industries are actually not doing well. That's a good sign that the market is not all that healthy, that maybe just some good earnings news or some new product announcement or something pushes a company and a few of the related companies up. But the rest of the market is responding to something maybe more important and more telling of where things are really going. So here is the advanced decline line, and I went back to the beginning of 2015, and again, 2015 was a rough year, and it was not a good year from an advanced decline standpoint. You can see it was pretty flat, so you didn't have very encouraging breadth. So here is the market. I went back to the peak last November, and from last November, we're just now getting back to that spot. We're just barely off of all-time highs, as I showed you on the previous chart. But look at the advanced decline line. The advanced decline line is telling us a better, different story about the health of this move. So from here to here, we had the big downdraft, and we saw that in the AD line as well. Now you can see this slopes down while this stays flat, which might have been an indication. And then from here, we've been doing better. So, folks, this kind of looks like the MACD line and relative strength like I've been showing you, but those to me are more short-term, more momentum indicators, and again, more short-term indicators. This one is more of a broader, better, more serious look if you're something other than just a short-term trader. You probably wouldn't pay too much attention on this. You might pay some attention, but if you're thinking beyond and you want to gauge what the possibilities are for a few months or even further out, then you begin looking at these more important breadth indicators. And what I'm showing you here is that these kinds of things would support what otherwise is not a very well supported case if you look at other short-term headwinds for the market. So not that we're going to have a great year in 2016, but one should be encouraged by some of the indicators like the breadth indicators that I just showed you. I'll be back, of course, with lots more. Thank you, as always, for watching and listening, and I'll talk to you very soon. Bye-bye.